Welcome back to another episode of Money and Medicine. We hope you find it useful if this is the very first time that you are joining the channel today. Vanner, quickly, I'm the first time on Money and Medicine. Why will I watch this channel?
So if this is the first time you have tuned in, a very warm welcome. We started Money and Medicine as a platform where we want to educate and empower medical professionals to make informed financial decisions. Stefan, I think this platform was designed with the purpose to explain financial jargon in layman terms. And I think that ties in with today's episode as well,
Yes.
where we will discuss complex investment jargon and just make it understandable for the medical professional out there.
100%. And I think we also have a vision to be the most trusted platform in the market where it's easy to understand layman terminology that you can access at any stage in your busy schedule. We hope you enjoy this episode. So today we're going to talk about investment jargon specifically, and we pick this up quite a lot when we deal with clients and you try to explain something that you can just get a feeling of they've got no understanding exactly, which is totally understandable. Medical terminology is their profession. That's where they specialize in. So today we're going to specifically focus on trying to simplify, put a bit of structure on a lot of investment jargon. So I think the first thing we normally try to explain to clients, or one of the terms that's thrown around quite a lot is asset allocation. Yeah. That is in your simple, I don't have a clue what that means. How would you explain asset allocation?
Yeah, Steve, I think we earlier did a video on this on Money and Medicine as well. You can go to the YouTube channel, you can look at our previous episodes where we talked about the different assets that you can invest in, the different asset classes. But I think when it comes to investments, you're never going to be able to shy away from this terminology. And I think asset classes is just basically when you invest an amount of money into a vehicle, that's basically how you spread your risk. It's going to be how you diversify your portfolio by investing into maybe a conservative investment and going into a more aggressive investment platform.
100%. Yeah. And I think if you just look at the word, it's where your assets are allocated. In other words, where your investments are allocated. So whether that's allocated to a specific segment of the market, let's say stock market, or whether that's allocated to the bond market, that is then your asset allocation.
Correct.
Alongside asset allocation is also another terminology that we hear quite often, which is referred to as volatility or fluctuation in the market. Easy way for you to explain that typically to a client?
I think it's very easy if you also demonstrate the volatility on a client when you sit in front of them by an example. And that's necessarily going to be the up and down that you experience in your investments. That's going to be where a investment market drops. For instance, if you have received a negative growth on your portfolio, and then a couple of months later you received an upside where you might receive a better return on your investment. That's going to be the volatility. The volatility also depends on going back to the asset class. Which asset class do you invest in? If you invest in a more conservative asset class, like cash, for example, you will experience less volatility.
100%.
Where if you invest more aggressively, like in equity, which is the most aggressive asset class, you will experience more volatility. And I also think when you look at your current investment portfolio, it also depends on the investment term that you invest in. If it's going to be more short term, when you look at your investment, you will receive less volatility because you can't basically allow a situation where you're going to receive those ups and downs. Because if you need access to that money, you're going to receive a negative return and you're going to actually lose out on money.
100%.
Whereas over the longer term, like you would understand, there's going to be more volatility, because more volatility is going to be a more aggressive asset class, which in return will also give you a higher growth.
Okay. So I think to summarize that, then volatility is the ups and downs in the market, the fluctuations in the market. And what you're saying is the more equity or more aggressive exposure you have in terms of your asset allocation, the more volatility will experience. Yeah. And the more stable you go in terms of cash and bonds, the less volatility you will experience. So you will experience sort of the straight line or smoothed line in terms of your fluctuation in the investment market. So let's get to the good part. Returns. What does returns mean?
Return will be the actual amount that you receive on your investment. That will be the growth. I think in simple terms, it will be the growth that you receive on your investment.
Simple. That's how you measure performance. Another word that I also hear quite often is yield. Yield is also a way to say, well, this is how much the investment performed. Is also expressed as yield.
And what I've seen is, and our clients would also see it, is when you meet with an advisor, return is predominantly or mostly measured against CPI. In CPI is inflation. So when they talk about the return on investment, it will be CPI plus 1 or CPI plus 2.
Very true.
So it's always measured against, or not always, but mainly measured against CPI.
Yeah. And that's also something on that point, it's something that you can also quite easily access on the fund fact sheet. Yeah. So if you are invested in, let's say, company A balance fund, on that fact sheet of the balanced fund, it normally says what is the target return or the target performance that they're trying to track, which is a measure of CPI plus 3 or CPI plus 5 or whatever.
Maybe, Steve, for the listeners that doesn't know what CPI is, just maybe an explanation of what CPI means.
Yeah, so CPI is basically inflation, consumer price index, and it's a way that they measure what a basket of goods will cost every year. So in layman terms, if let's say you've got 10 Rand and CPI is 10%, it means that next year that same 10 Rand will have a purchasing power of 11 Rand. So if your investment doesn't exceed sort of like the deterioration of the currency, then you're actually not making a real return on the investment. So in other words, if you had that 10 Rand and you invested that in the market and you got 10 Rand 50 back, it means that actually you can't buy the same amount of goods. So there's actually not a real return on investments.
Yeah, that's a great explanation. And then the next thing that maybe needs to be explained is, what is a unit trust? Because we get asked the question quite often, is what is a unit trust? Is it a vehicle? And it's not a vehicle. So maybe just an explanation of what a unit trust is.
So a unit trust in layman terms can be seen as a big portfolio of investments, which is then basically subdivided in smaller units. See it sort of like as a big trust of investments and then in a couple of smaller units, which is then referred to as unit trusts. You can buy these units. The nice thing about it is you get exposure to various asset classes, opposed to having to use your own physical money to buy shares or to buy into the bond market into those separate entities, if I can explain it like that. As an example, let's say you invest 100 Rand, that 100 Rand in a certain unit trust can have exposure to the sort of obviously a percentage of that whole portfolio's mandate. So you can have a unit trust that has a balanced mandate, or you can have a unit trust that has a specific focus on the equity market or the stock market. You can have a unit trust that is a conservative unit trust that's focused on cash and focused on bonds. So it all depends on the mandate of that unit trust. And over time, ideally, you would like the units to grow, and that will then again be your performance on the investment. So you every month, if you do a contribution monthly, you physically buy units in this unit trust, or if you do a lump sum, you buy that units at a specific price in the market time.
And I think how you're going to make your investment return on that is when you sell that unit at a higher price than what you bought it.
100%. There's obviously then taxes involved into a certain extent, but I think the purpose of this show, we're not going to go into taxes. Maybe something that we can also address in another episode. Taxes.
And then I think this ties in very nicely to returns and as well as to volatility. When you listen to an investment podcast, or if you listen to somebody talking on a radio show regarding investments, I know they talk a lot about this on 702, on the Money Show. You hear the term being thrown around, what is a bull market and a bear market? Maybe just an explanation of what is a bull market and what must bear market be.
Very important point, because I totally agree. You quite often hear that we are now currently going into a bull market, or the US is currently experiencing a bear market, or whatever the case might be. So a bear market is a general decline in a certain market. So if we're saying, the East are going through a bear market, or they're experiencing bear markets in a certain sector, it means that sector is generally declining. It's experiencing losses. A bull market is obviously just the opposite of that. It's experiencing a general increase over time. So if we say we've been in a bull market for the last 5 years, it means that physically we've been experiencing growth in the last 5 years.
I think a great example of that has been the US. You just mentioned the US now. I think the US has been in a bull market since about 2017, where there's more jobs that's been created, and all of that. So currently the US is in a bull market, what we've seen. So then we are post-COVID now, Steve, and something that has shown a lot of interest is commodities, people investing in commodities. What is commodity investment?
100% correct. We've also seen quite a big boom in the commodity market locally. Commodities is your raw materials, basically oil, copper, coal, livestock. It's physical raw materials that you can, whether you harvest it or whether you mine it, it's something that is a primary product that can be used in order to obtain a tertiary product. So that is meant by the broader term of commodities.
Commodity investment.
Yeah.
Okay.
But then also just another question that I get quite often is what is the difference between passive investing, like ETFs and index investments, the likes of companies like Signia, 10X, your passive investors, versus active investors, which is typically like Alan Gray, 91, Glacier, sort of like your a Stanley fund. It's typically an active manager. What is meant by that terminology?
I think, Steve, that's also one of the biggest debates in South Africa, whether you have to go passive investment or whether you have to go active investment. If we start off by active investment is where you invest in a platform where there is fund managers that basically have a specific mandate which they want to follow. So they use their qualifications, they use their experience, and they actively invest that fund with a specific strategy. And that strategy is mainly to outperform a passive market. And a passive market would be where you are looking at an index investment, where they follow a specific index like the JSE and the top 40 companies, the All Share, as well as the world MSCI, where they basically follow the index there, and it's a more stable investment. It's much cheaper to invest in an index because there's not a lot of cost involved. It's not a lot of human resources that goes into that.
100%.
It's basically algorithms that has been plugged in,
yes,
which they follow that index.
Yes, to track that index. Yeah. And we like the S&P 500 is also a good example. I'm a firm believer. I don't know what's your view on this. To maybe get like a combination of the two. I think that will also be a true form of diversification. Is to have a portion asset allocation towards a passive manager as well as a portion towards an active manager, and you can have both in your portfolio. So have the likes of an index to maybe bring the costs slightly down, but then also have the active managers involved to try and exceed market returns. Because if you are invested in an index, it's exactly like you're saying, you will always perform what the market is giving you. So if markets are doing 8%, that's what you're going to get. Whereas if you invested in an active manager, they will they will aim to outperform the market, which is also referred to as what we call alpha. So if we say we've got an alpha of 1% or 2%, it means that we've actually outperformed the market by 1% or 2%.
And I think just something that's very important to mention, it's not to say that if you're going to invest in an active investment that you are going to outperform the market.
100%.
You have to choose and identify the correct asset manager and also understand their mandate, because an active investment is not necessarily going to outperform a passive investment. I think that's where the big debate also comes in the country. What is offshore investing? Offshore investing is becoming really popular at the moment. Everybody wants to take money offshore, take money out of the country. So maybe just explain to everybody in layman terms, what does offshore investing mean, and how do you do offshore investing?
Yes, that is you're 100% correct in the question. I think it's something that has been thrown around over the last 5 to 10 years quite predominantly, specifically in South African markets, is to say, no, take your money offshore. Offshore means physically you are taking your money abroad. So you're taking it across the borders of South Africa. So you're literally getting exposure into foreign markets. That can be done in two ways. The first is where they do it through what they call a swap fund. A swap fund just basically means that at the end, the money will come back in South African rands. It's actually a rand dominated investment solution. Then if you go hard currency, which is option 2, that is where you physically take your money, you convert it into US dollar, or you convert it into sterling pound, or into euro, whatever currency you want to use, and you invest physically in that market. So you are capped R1 million currently as we shooting this podcast.
So that would be as an example where you take money out of the country. You open an offshore bank account and you're physically taking your money out of the country.
Yes.
Where the first example is you just have a lot of offshore exposure in your local portfolio.
So it's still offshore exposure, but at the end of the day, the money will come back in rands. You're also not limited to your allowance. So the South African Reserve Bank actually allows only a certain amount that can go out per annum. With a swap, it doesn't contribute towards that allowance, whereas if it's hard currency, it does contribute towards the allowed limit that you may take out of the country. So yeah, that will, exactly like you said, that's typically where there's an offshore account in Guernsey, or there's an offshore account in Isle of Man, typically your tax havens, and you invest the money in that bank account, and then from there it's invested in a foreign fund manager as well, the likes of obviously fundsmiths, etc. So that is what is meant by offshore. It's a great, being 100% exposed to South African markets. Again, this is factually, I'm not giving advice. Obviously, if someone out there wants to have a closer view into how they need to structure their portfolio, we can have a meeting with them. But factually, if you only invested in local markets, you actually got less than 3% or 4% exposure to global markets, if not less. So having an offshore or a bigger focus in terms of your investment will also be a good practice, just to get some, professional diversification out there. Also important to talk to the right people, because you need to know exactly what is happening from a macroeconomic perspective and in international markets in order to do that effectively. There is a lot of risk, like currency risk, volatility risk, political risk, that can all contribute towards your final investment. Then I've got a question for you, from a last question from my end, is what is an investment platform? And the reason I'm asking this is quite often I would assume when I meet with somebody is to say, look, we're doing it through platform A, but we're investing in company B. As an example, we're going to invest you on Alan Gray's platform, but we're going to invest you in a 91 fund or an Investec fund. How is that possible? What is meant by that?
Steve, I think that's a great question. I think an investment platform is basically just an online service. So that's the company or the online service that you use to buy and sell those units, and also to hold that capital. So like you just explained now, the investment platform is not going to determine the growth. If you invest with Alan Gray, it doesn't necessarily going to mean you're going to get a better return 100%. Than if you're investing with 91, or if you invest with PPS or any other unit trust platform. So that's basically just the company, or the like you mentioned, the service provider. The service provider that's basically allowing you to trade and buy and sell and hold those funds, which is very important because that also comes at a fee. Yeah. So you also have to look at all these different platforms and see what fees do they charge to allow you to buy and sell on your current investments.
Very important point. So for those of you out there that it is your very first time that you are watching this show, we truly hope that you did find value. We will definitely do more podcasts on different terminology. And we also want to encourage you to subscribe to the channel if you want more content and if you want more future relevant information. And hit the like button if you found this useful. You're also welcome to share some comments. We will get back to you as soon as possible. Please also then check out our website on www.moneyandmedicine.co.za. Go to the resources tab and check out some podcasts and videos that we do have on various topics.
Until next time,
plan the plan.